Hi everyone, I'm Rohit Yadav, and today we are covering a venture asset class from a strategic perspective while taking an advisor and an asset manager lens. As venture capital navigates a pivotal phase, the future of the asset class remains a top strategic priority and a question for all of us. And that's why I'm on this journey to unravel different forces impacting the ecosystem and how all of us, investors, founders, and ecosystem players, should make sense of all of this. And to do this, I have a very special guest joining us today, Frank Tanner. Frank, thanks for joining us.
Right. Glad to be here. Thanks for doing this.
Yeah. So Frank leads at the early stage venture strategy and manages the private investment for platform at Morgan Creek Capital Management. Now, Morgan Creek is a firm founded in 2004 by UNC Endowment's former CIO, and Frank's responsible for sourcing, due diligence, deals, as well as manager research and selection across primaries, co-investments, directs, and secondaries. So that's quite a mouthful. Frank attended UNC, where he also played basketball. This is something that we both have in common. So love that, Frank. I'll hand it over to you, Frank, and please introduce Morgan Creek, its different business line, the origins, and business growth briefly to the audience.
Yeah. Yeah, happy to. And thanks for the intro. And glad that we share the basketball love and passion for the sport. But Morgan Creek as a firm, as you mentioned, we were founded
Yeah.
2004, came out of the UNC endowment. And it's not the only kind of endowment history that we have at the firm today. We also have Notre Dame, where our CIO was previously, Stanford represented, Kauffman Foundation, and Duke's endowment. So that's kind of the cloth that we were cut from. If you look at the platform today, it's very different than it was 20 years ago. We're much more specialized across thematic areas and areas of conviction. So you mentioned a lot in my bio, but I primarily focus on venture capital these days, specifically early stage. And then we also, within the private asset kind of platform, oversee more kind of broad-based, diversified global portfolios, including real estate, energy, private equity, buyouts, venture, what have you. So yeah, that's kind of the platform today. We manage capital for various clients, all the way from high net worth and family offices through institutional capitals such as pensions. So
Okay.
yeah.
So that's quite a broad spectrum, right? Within alternatives, where is the main focus for you guys right now? Is it real estate? Is it venture? Is it private equity? Where does the main focus lies right
Yeah, today it's primarily venture capital, and that's kind of split between a couple of different strategies. My kind of universe is within the early stage venture side. So we're investing into funds.
now?
So
Okay.
think sub $100 million funds, typically pre-seed, seed focused, mostly emerging managers. We define that by funds one, two, and three. We also have another kind of business line under the Morgan Creek umbrella called Morgan Creek Digital,
Okay.
and they make direct investments into blockchain infrastructure, digital assets, data plays, infrastructure, et cetera. And yeah, that's a direct series of funds that we launched back in kind of 2017, 2018. That was born out of some of the fund investing and thesis building that we developed on the fund side, in fact,
Okay.
dating back over a decade.
Okay. And you mentioned you have different kind of LPs. So you have family offices, you have endowments and so on. Where does the biggest chunk of LPs come from? I mean, if it's a public information.
Yeah, I mean, we can speak broadly to it. Some of it's public, but by investor count, it's typically individuals and families. By dollar amount, it's typically the institutions.
Yeah.
So fairly concentrated through that lens. And generally, a public pension or someone of that nature anchors some of our discretionary funds. And then on the non-discretionary side, it's generally family, single family, multifamily offices, and kind of affiliated foundations that we work with.
Okay, got it. And so where do you see Morgan Creek 3 years down the line?
Yeah, 3 years down the line, it's hard to say exactly. My hope would be that we continue to build on this thesis and reputation brand that we've developed in the early stage ecosystem among VCs, and we just expand access to that segment of the venture asset class. And that's what's exciting to me is that, while sophisticated institutions have been able to access venture for years, it has been a relatively kind of difficult to navigate and access segment of the market for a lot of individuals, families, even just smaller teams at some smaller institutions. So yeah, my hope would be in 3 years that we continue to raise and deploy into this opportunity set.
Okay, so you really believe into democratization of VC as an asset class.
For sure.
Awesome. Okay. So, because you're so much into alternatives and private markets, I want to ask this question. Why is these two topics becoming so important in a portfolio context, especially for high net worth individuals and family offices?
Yeah, it's a great question. I mean, I think like it's the next iteration of creating a more kind of balanced and sophisticated portfolio. So adding alts after you have kind of public securities, other areas covered in the portfolio, you can start to do stuff that's more kind of on the edge or fringe. The obvious reasons why you'd want to do that are diversification, kind of uncorrelated nature of the returns, some additional upside, so some alpha that you can capture through investing into alternatives, specifically venture and early stage venture. I think realistically, and this is something that's not always, I guess, a lens for the institutional world, but for a lot of families, there's just an affinity to be part of something that matters, is impactful potentially,
Okay.
is value aligned with kind of the family's initiatives in business or priorities. And venture can offer a great kind of access point for some of those objectives. So, you're getting exposure to new technologies, cutting edge kind of innovation. All right, to finish that thought, venture offers an outlet for families to have the impact that they are seeking through kind of their investment activity.
Okay. So for the high net worth individuals and family offices, it's not just about the return that they are seeking with venture and some of the other private markets. It's also about impact, and that's what you're highlighting right now.
Yeah, impact and just an affinity for innovation and new technology and being part of what's new in the world, and whether it be impact or, yeah, just new technologies.
Okay, so let's move on to the LP view of the asset class and what we can capture from what the family officers are thinking and so on. Yeah, so the first question is around strategy. So private landscape is really broad. It consists of private equity, real estate, obviously venture capital, and so many other asset classes like infrastructure, debt, equity, and so on. How do you at Morgan Creek, not you specifically, maybe your colleagues do because you have an OCI role as well, and you do advisory projects as well. What is your discussion going on with family offices when they want to take a long-term view versus a tactical view on private markets?
Yeah, I think a long-term view is almost a prerequisite for a lot of the segments within private markets, specifically venture, because the horizons are so long.
Okay.
So our conversations with families are exactly that. This is not a tactical play, right, in the portfolio. Perhaps there are some trade-like investments you can make in later stage growth companies, pre-IPO, private
Mhm.
companies, assuming the IPO window is open. But more realistically, if you want to add kind of this access to innovation, which we think is an evergreen opportunity, you need to do it in a programmatic and with a long way in a long-term view of the asset class. So our advice is, have a long-term view.
Okay.
It's all about partnering with the right people first and foremost, and then building on that. Yeah, we have our views on where the best places to deploy capital within private markets are, but I think starting with that understanding of that this is fundamentally different than some of the investing that's done in, liquid markets is kind of critical to access the field.
Okay. And I want to double down on what you said right now. So, what is your feeling on where the kind of top opportunities are within private markets?
Yeah, top opportunities. I mean, um, we spend all of our time in venture, so that's where we're most knowledgeable and have the best on the ground pulse. And yeah, I would say the best opportunity from our perspective is within in venture. And this is always, I would caveat with, this is always dependent on the investors' objectives and
Mhm.
what their goals are. But um, early stage venture has a lot to offer in terms of upside, return asymmetry. It's a sub asset class within venture that's driven by the power law. So it's in any portfolio, it's sometimes hard to capture dispersion of returns, which allows you to add alpha to a portfolio, and you need those risk buckets from general modern portfolio theory to to optimize your overall return and diversification. And venture serves a critical role in that. So
Okay.
I think as we segment the kind of landscape and look at different areas within venture, as you move more to kind of a multi-stage strategy, it can still serve a great purpose in the portfolio. Diversification, a little bit uncorrelated with some of your other asset classes, but you might lose some of the kind of asymmetry there in terms of the upside
Okay.
potential for more growth stage investments.
Okay. So I want to follow up, keep the rhythm of what you were mentioning about asset allocation within VC and so on. What's your tactic? What's your thought process behind how should a venture portfolio look like? I'm not talking about individual bets, but rather what you mentioned a couple of minutes back is about, let's say, different areas within venture or different geographies. So how do you look at this allocation landscape and what's kind of the best portfolio recommendation from your side?
Yeah, I'd add the disclaimer. None of this is investment advice, but
Definitely.
yeah. So I guess the semi recommendation or thing I would say here is that it depends on where your skill set lies or who you're partnering with and where their skill set is. So for us, given the network and ecosystem connectivity that we've built, the best opportunity for us and our clients that want to partner here is with the smaller funds, what we call keynote venture capitalists. And that usually takes the form of a lot of solo GPs, a lot of like former operators, angel investors, spinouts from some of the tier one firms that partners are leaving, and pre-seed seed. So they're typically first check investors into startups that are relatively unproven in terms of product market
Mhm.
fit and early traction, even though they might have some of that. But it's usually kind of founder driven bets. And, when you aggregate a basket of these managers, we would never recommend doing one or two kind of we call micro VCs
Okay.
on a one-off basis because there's too much risk there for the typical, family or portfolio. And but when you aggregate them together, given the asymmetry and kind of power law returns, the mean return in early stage is actually pretty attractive, and you can
Okay.
narrow the band of return outcomes around a mean return, and then any alpha that you can generate in selection is outperformance to that mean. So in some ways you have the advantage of volume and portfolio size
Okay.
for early stage. Now that doesn't hold true as you go into other asset classes or even growth stage within venture because the returns are more normally distributed. So where you're trying to concentrate heavily and add alpha through concentration and selection, the more funds, the more shots on goal you have at, say, the growth stage
Mhm.
is going to dilute your return towards like a median slash average return, which is not as attractive as it is for early stage. I think this is a pretty like advanced maybe approach to venture. I think if you're have never invested in anything, it's probably makes sense to not try to implement selecting micro VCs on your own and partner with someone. I think it also pairs well with kind of a barbell strategy of just getting some of the beta exposure, which can be pretty good to some of the multi-stage like, venture platforms out there that will be in a lot of deals. Also, investing a lot more capital, so the has implications on the ROI. But it's a great kind of foundational exposure, and then adding a little bit of upside and risk through the early stage portfolio in a basket approach
Got it.
is kind of how we think about it.
Awesome. I think you explained it beautifully. I mean, there are two buckets to it. One is the early stage, as you mentioned, and second one is the growth stage. At the early stage, if I understood correctly, your focus is basically to have not just couple of bets in micro VCs or VCs, solo VCs, let's say, to have more bets. Although there's kind of a power law which is at work, but because of the huge variation in returns and where that extreme opportunity might lie, it makes sense to invest in multiple managers at the very early stage. So that's what you're focusing on. And obviously,
Yep.
it differs on the growth stage size. I want to take one step back to this, and because you are into alternatives as in general, how would you compare the focus of family offices, LPs who are investing in alternatives with with PE versus VC. So, what is that discussion going on if you have those discussions? And if you, for example, have to convince a family office to kind of leave the PE and come to VC, what could that argument be?
Yeah, there's obvious benefits, like we mentioned earlier, around the diversification angle and just different asset class, different exposures, different correlations. I think for early stage venture, that kind of opportunity cost approach to allocating capital is a strong case for early stage, given the upside returns associated with it,
Mm-hmm.
which aren't typically present with like a buyout fund. I think the other argument which can be made is a lot of again, it's dependent on your network and your skill set and who you're partnering with. But if you're new to alternatives and you're trying to get access to buyouts through some type of platform, you really need to pull the layers back and see what underlying exposure you're getting. I think there's a lot of kind of market efficiencies at the higher end of the market, which kind of cap your ability to add alpha and upside to your overall portfolio. So meaning, it's a little bit more financial engineering and dependent on kind of market cycles than true kind of value add opportunity if you're, in a lower middle market kind of buyout strategy with kind of deep operational
Yeah.
expertise, good entry valuations, conservative leverage.
Yeah.
So I don't know. I think there's good opportunity both in traditional PE and venture. I think the argument to move from PE to venture it depends. It's different for each investor, but an obvious one is just that, it's a different type of exposure and it offers you something that traditional PE often can't.
Okay. So I want to move on to venture asset class. What is the expectation of LPs, institutionals, family offices for venture as an asset class, not specific to early stage, but as an asset class in short to midterm, let's say 1, 2, 3 years?
Yeah, I guess. Yeah, I don't know that there is a single consensus here for the next few years on venture as an asset class. I think like we've gone through a reset.
Mm-hmm.
I think there's still some pain to come potentially
Mm-hmm.
in terms of downside to some of the valuations of companies that have kind of extended runway a little bit, but still haven't found that product market fit or still need to grow into valuations that were set in a previous era, namely pre 2022, like specifically Q1, Q2 of 2022. So we're still kind of working through it, I would say. I think if you extend your horizon and look 3 to 5 years out, I think, I would hope IPO window reopens, exits become a little bit more common for some of these funds than they are right now. And then I mean, there's so many directions we could go with this question, but on the ecosystem side, I think there's a further kind of um, cooling, I guess, of the early stage kind of micro VC world, and
Mm-hmm.
some funds won't continue on, and GPs will go do something else, and then further concentration at the kind of upper end of the market with some of the multi-stage funds. So I
Okay.
see this kind of bifurcation in the market, uh, just progressing on the same kind of trajectory it is right now,
Mm-hmm.
and it presents opportunity on both sides, right? So,
Okay.
um, so yeah, I don't know. Is that kind of what you're thinking of in terms of future of
Maybe I
prognosticating
can
on this?
ask in another way altogether. So, what's the reason why LPs are not investing in venture asset class right now? So, we hear arguments
Sure.
that venture is not providing DPIs adequate to what the expectations were from LPs. Or, for example, many LPs have not seen returns, the variations are quite huge. They are seeing a lot of pain in the market and so on. So, within context of return and risk, of venture as an asset class, like what would be the expectation be from LPs?
Yeah, I mean, I personally think it's a great time to invest
Okay.
into venture. I think like that sentiment probably should have been being expressed like in 2020, 2021, when everyone on kind of the allocator side was piling into these funds and were, setting new records
Mm-hmm.
and valuations were all-time highs. Fundraising cycles were compressed. There was, you know, probably corners cut in certain areas from a diligence perspective. And then we've gone through this reset and we're still kind of making our way through. But I think this is when, it's more interesting as an allocator to have, exposure to these next few vintages versus the last few. I think DPI gets a lot of attention in this market. I think that helps. I think there's also a balance of keeping some exposure to your winners and letting that ride, and having the duration to, um, be exposed through market cycles and get to the other side and capture the upside once cycles, IPO windows reopen and cycle returns. But yeah, I think it's easy to have a backward looking kind of view and say it's been a tough kind of downturn, but also I think if you're looking forward, this is relatively the more attractive time to invest. Valuations are down. There's been like a high grading of founder quality. No founder that just has an idea is going to market in this environment, although it's changing a little bit with AI and what that's enabled. But yeah, so from a structural standpoint, I think it's a great time. I know there's a lot of, I guess, structural limitations within like endowments on their private exposure and caps they have there, which limits their ability to act. But for someone with dry powder and capacity to add to private, this is a great time. And then pair those structural setup with what's happening on the innovation side and AI. I think that's a huge opportunity in terms of the kind of new market sizes or new markets that we're going after and the sizes associated with those. I'm replacing not just software, $1.5 trillion kind of spend a year on software by enterprise, but also the labor part of the market, which is orders of magnitude larger. So that's exciting. And then also healthcare innovation, deep tech, defense. Yeah, there's just so much to be excited about from a kind of fundamental standpoint on innovation.
So my way of thinking it was coming also from an institutional background as you need to, because venture is a risk asset class and it's a long-term focus asset class, you need to allocate for long-term. Let's not play a timing game here. Right now is the time to invest or not. I mean, everyone understands that timing doesn't work most of the times for all active managers, whether it's venture, whether it's equities. So the idea here is, keep on investing, whether it's a down phase right now, or maybe it's an up phase. Obviously, a lot of folks are investing, but keep that rhythm. Don't just break from investing. And that's what happened with a lot of family offices, that they kind of took a break on investing, and which is probably not a good idea with venture as an asset class, because you need to contain that balance of investments to be able to capture every single vintage year of startups, right? How a startup is going to perform, it's actually becomes a reality 8 to 10 years down the line, which is not apparent right now. So to miss on that one vintage year of startups would be a pity.
Yeah, it's so true. I mean, you have to have a long-term approach to this, and it's not only near impossible to time the market in venture or any asset class. I would argue it's also kind of from a network, since venture is more so than any other asset class network driven.
True.
It's so hard to be tactical here. It's not like you're coming in and trading some liquid securities. You're coming in and having to act on bonds and relationships formed over years. And if you sit out a few vintages and then come back to it, those relationships might not be there, and then you might lose access essentially. And if not access, you might lose the kind of contextual knowledge you need to operate within venture. So and it pairs well with what our long-term outlook is on the asset class, which is innovation's an evergreen opportunity, and it is something that you should have constant kind of continuous exposure to.
Definitely. Let's dig down into the debatable topics of venture. First question I want to ask you, specialists versus generalists. What's your view on the VC asset managers on that side?
Yeah, these are fun to discuss because they're like very, people have strong opinions on both sides, specialists versus generalists, geographic focus, different lenses. So specialists versus generalists, we don't have strong views, interestingly, there. Our framework is more kind of a first principles approach on certain factors that, or, traits that any VC needs to execute against. Okay. So we call those the 5 S's. It's kind of like CPIC win, but they are source, select, secure, support, and signal. And honestly, we think, if you're doing those 5 things well, you can be a generalist or specialist. And sure, being one or the other could have advantages in certain situations. But yeah, that's kind of how we think about underwriting from a first principles approach. So we don't take a view on the specialist versus generalist until we actually get to know the manager and the strategy. And we try not to pre-evaluate, if you will, based on some of the traditional kind of factors that are out there.
I love your approach because it puts structure into the evaluation process. So it's the 6th S, right?
Yeah.
And what investment theory says is if you keep your investment structure in place, that's kind of a better determinant of success rather than if you meander through what's hot, what's not, or if specialist is hot in some periods for special kind of areas like AI or deep tech, for example, people or allocators might tend to focus, hey, let's put more capital into these areas because this is the hot topics which are coming up right now. And let's focus on specialists because these are the PhD guys or these are the guys who know how to build space stuff and so on. But the idea to build a structure of 5 S's or whichever that structure is and focus on that during the selection process is much more likely to predict the success of a portfolio than focusing on what's hot right now. Awesome.
That's right.
So then I would say emerging versus established managers over there as well, you won't have any strong opinions, right?
Yeah. So this is another interesting one. We don't have a kind of top-down view on established versus emerging.
Okay.
We, I guess, a byproduct of some of our bottoms-up kind of inputs has put us mostly in emerging. So from our current venture fund, we've done 94% into emerging managers. We define that as funds 1, 2, and 3. If you look across all of Morgan Creek's platform, we've invested 75% into emerging managers. And that's across, again, buyout, growth, venture, real estate, energy, what have you. Again, it's not that we went out wanting to be an emerging manager focused allocator. It's that's where we find the best alignment between kind of strategy, the pool of capital that's being invested, and also kind of where the general partners are, the solo GP is in their journey and career. And there's just like a different element of hunger, franchise building, next chapter, final chapter potentially, that these investors are writing. And yeah, I think that's like just been the sweet spot in funds 1, 2, and 3 for us across not just venture, but most asset classes. March of the Roman numerals, as we refer to it around here, just usually come with larger fund sizes and a bit of strategy drift and a shift from carry to AUM kind of driven managers. And yeah, so we do a lot of emerging. We don't have view on established versus emerging per se.
Got it.
There's obvious experience that comes with the latter, but yeah, that's how we think about it.
So the next debatable topic is, which is quite hot these days, should family offices do direct investments in startups, or should they focus on experts like yourself who are in the business and let them handle the investments into startups or venture funds, for example?
Again, it depends. I think like investors are also unique and have a special skill set and networks and operating history and whatnot. So yeah, some families are in a great position to make direct investments. There's a million things we could discuss on what advantages or disadvantages or good ways to do that or not. I think if you have put in the work and built the team and have the existing network to execute a strategy making direct investments, then that can be a great benefit to the program. I think if some of these things are less close to shore, less familiar to you, maybe there's not a network or operating history there strategically or otherwise, it makes sense to partner, right? So I think in both scenarios, families can benefit from expanding either an existing network or adding a completely new network through partnering with like a fund of funds or several, venture managers.
Mm-hmm.
So I think it's only additive if they do want to take a partnership approach. The thing that I always ask, families that we work with, and not just families, but ourselves as well, with any deal, is why are we seeing this? So adverse selection is a very real thing
Okay.
in the industry. So yeah, if a co-invest comes across your plate, um, just having a self-awareness and kind of the context of where you exist within ecosystems and networks, and answering for yourself why you're seeing it, and is it adverse selection, or
Okay.
is it truly kind of an advantage that you have that you're seeing it, and it's a kind of proprietary look, if you will.
Got it. Got it. So there's evaluation strategy for family offices and how they should think about it. There's advantages and disadvantages to both, but yeah, it depends upon bit of what the family office is looking for. Understood. Um, I want to move to the venture asset class insight, like specific insights within the early stage because you're focused over there. Where do we stand with the early stage ecosystem? And you can talk about valuations of startups, you can talk about number of deals, you can talk about specifics of what you are seeing out there with respect to the ecosystem, and how do you see it evolving in 2025 or maybe early 2026?
Yeah, I think early stage is pretty unique. I think it's less driven by fundamentals and multiples on a top line or profitability metrics. It's more kind of an output, valuations that we see, which are generally sub 20 million and that's a very broad range, but
Yep.
call it, high single digits to 20 million for some of these seed deals, is generally where kind of the output falls on valuation, because founders are willing to share X% of their company. They need X millions of dollars to build their company to the next milestone. The early stage investor kind of pulls the capital, usually need to deploy something that matches with what they need to build to that milestone. So you kind of arrive at these valuations. It's moved around a bit through 2020 to now, in that they got a little bit inflated. They actually didn't pull back as much, but
Hmm.
really valuations have been, I forget who kind of termed it this, but kind of an exhaust of the negotiation that happens between VCs and founders. As a investor into the space, sure, it matters your entry price, but yeah, you're still getting in at absolute kind of low terms and good ownership of anywhere from single digit or percent up to 10+% in these companies. And then yeah, looking out, I think like that continues on. Maybe early stage valuations increase a bit. I think we are seeing kind of this world of have and have nots
Hmm.
for startups right now. The term that's going around right now called, is the startup or founder legible?
Okay.
Meaning, do they have a lot of traits or characteristics, factors that pattern match really well to, you know, previous kind of successful outcomes in businesses? So what university did they go to? Technology company are they spinning out of? What did they do previously? Is it kind of a legible founder? I think the opportunity for a lot of seed, pre-seed investors right now are finding kind of non-consensus founders,
Hmm.
given the market is pretty efficient in pricing founders by legibility, for lack of a better term.
Okay.
But yeah, if you're an early stage investor, you can find someone that's not consensus, and with a little bit of execution and proving out
Hmm.
whatever the startup is going after, in terms of business opportunity or market, they become kind of a legible opportunity for some of the larger funds. And at that point, you have the benefit of large pools of capital, multi-stage funds wanting to put, a lot of capital at pretty non-dilutive terms into your company. And then it's up to the founder to use their judgment to, you know, decide what the right amount is, what the right, raise is for where they are in their life cycle, and not overfund,
Okay.
but also use that to their advantage.
Okay. From
So yeah, I think that continues over the next several years.
Okay.
And
And so
yeah,
from your point of view, you're allocating to funds, which are then
yep.
investing into startups, right? Has your investing activity strengthened in 2025? And do you see the pace picking up much more because you feel the ecosystem is coming from a downturn and moving towards an upside? How do you feel about allocating to managers in this environment?
Yeah, we're very constructive. We are subject to the same fundraising environment that a lot of managers that we invest in are subject to. So it's a tough environment out there. That said, there's not a ton of institutional type allocators that are spending as much dedicated time on this part of the ecosystem. So
Okay.
yeah, we're super optimistic from that standpoint and think it's a great time to be raising and be allocating through 2025. So activity from my standpoint will increase. And then I think what we've seen though is kind of the inverse of that over the past year, which is kind of a flight to perceived safety or what's familiar, or proven track records,
Yeah.
long track records. And that's manifested in a lot of the larger multi-stage platforms becoming just that, which is larger. I think the stat is that I believe PitchBook put out 30 firms raised 75% of the capital
Yeah.
into last year.
Okay.
And yeah, it's pretty staggering. I think like halfway through the year, it was 50, almost 50% went into 6 firms. So yeah, there's this like flight to safety element that's happening. I think it plays very well and among investment committees. Again, it's a very legible strategy, right? To invest
Yeah.
in what are, you know, top tier by definition because of their name firms, and they've done quite well. But there's a bit of an overlooked element of this micro VC part of the ecosystem, which we think serves a very meaningful role and is strategic even to some of the larger platforms.
Okay. I mean, venture is driven by alpha, right? So you need to find one investors need to find the alpha, and maybe the alpha is not with the bigger firms, maybe the alpha is with the smaller firms, or maybe it's in different category altogether. So this is something for the LPs and investors to see. But thanks a lot, Frank, for joining us today and shining light in all those topics related to venture as an asset class, where it stands with respect to the portfolio context of family offices and institutional investors, and talking about the specifics of a early stage segment. Thank you so much for joining and enlightening us.
Yeah, thank you, Rohit. It's been a pleasure and big fan of the work you put out and all the insights you provide on the ecosystem. So thanks for that.
Thank you so much.